What happens to someone who holds the same investment for 1 year? Introduction. In modern markets dominated by speed, notifications, and constant price updates, holding the same investment for a full year can feel radical. No frequent trading. No constant switching. No reaction to every headline. So what does an investor experience, psychologically, financially, and behaviorally, when they commit to holding one investment for 12 months? This research explores the emotional phases, cognitive shifts, and structural outcomes of a 1-year holding period. 1. The emotional timeline of a 1-year hold. Phase 1. Excitement, weeks 1 to 4. After buying, the investor checks prices frequently. Every small move feels meaningful. Confidence is high. Conviction feels strong. Phase 2. Doubt, months 2 to 4. Volatility appears. Headlines challenge the thesis. Social media highlights. Better opportunities. Loss aversion, described by Daniel Kahneman, begins to activate. Temporary drawdowns feel personal. The temptation to switch increases. Phase 3. Boredom, months 4 to 8. If the investment moves sideways, boredom sets in. Humans crave stimulation. Markets reward patience. Many investors sell during boredom, not fear. Phase 4. Emotional detachment, months 8 to 12. If the investor survives fear and boredom, something changes. Price swings feel less dramatic. Daily noise loses power. Long-term perspective strengthens. Monitoring frequency often decreases naturally. 2. Psychological effects of holding. 2.1 Reduced action bias. Humans prefer doing something rather than nothing. But holding trains the investor to resist unnecessary action. Inactivity becomes a skill. 2.2 Volatility tolerance increases. Experiencing drawdowns without selling builds emotional resilience. Historical market events such as the 2008 financial crisis demonstrate that temporary declines are normal features of markets, not anomalies. Living through volatility changes perception of risk. 2.3 Identity shift. The investor may shift from "I trade" to "I allocate capital." This subtle change often improves decision quality. 3. Financial consequences. 3.1 Compounding begins. Holding allows dividends to accumulate, growth to materialize, business performance to reflect in price. As long-term investors, like Warren Buffett emphasize, time in the market often outweighs timing the market. 3.2 Lower transaction costs. Fewer trades mean lower fees, fewer tax events, reduced slippage. Performance improves not because of higher returns, but because of fewer leaks. 3.3 Clearer evaluation of strategy. A full year allows proper evaluation. Was the thesis correct? Did fundamentals change? Or was volatility simply noise? Short holding periods rarely provide meaningful data. 4. The hidden internal changes. After 1 year of holding, many investors report improved patience, lower stress levels, less screen dependency, stronger conviction frameworks. They begin distinguishing between price movement and business performance. 5. Risks of holding for 1 year. Holding blindly can also be dangerous if fundamentals deteriorate. Structural industry change occurs. The initial thesis was flawed. Patience must be paired with monitoring, not obsession, but awareness. 6. The paradox of time. 1 year feels long emotionally, but short financially. Many transformative investments require multiple years to fully mature. A single year often serves as a psychological training ground. It teaches emotional endurance, volatility normalization, reduced impulsivity. Conclusion. Holding the same investment for 1 year is less about return and more about transformation. The investor who survives fear, doubt, boredom, social comparison often emerges calmer and more disciplined. In markets flooded with speed, patience becomes a competitive advantage. Because sometimes, the biggest change after 1 year is not the portfolio. It is the investor.